Hi, this is Steve with Capital Gains Advisory. Today we're going to talk about tax planning strategies at the end of the year, simple ways to pay less. Let's jump into it. But before we do, our safe harbor statement: the information contained here should not be relied upon as definitive tax or financial advice. Always consult with your accountant, financial advisor, and or an attorney before making financial decisions. If I am your accountant or your financial advisor, please consult with me before you independently make any decisions. Let's go ahead and move on. We'll talk about our objectives. We're talking about three simple strategies. These are not very hard. This is easy money. We're talking about timely filing, proper withholding, and retirement contributions. And we'll finish up with the review of the 3 points. Timely filing. What is that? Well, you have individual income taxes that are due on a certain date. For most people, it's generally April 15th. If you have a small business entity, such as a partnership or a S Corp or a C Corp, you also have a filing deadline for those entities. If you don't file on time for any of those particular taxes, that can lead to penalties. Now, when we say file on time, we are also referring to filing where you don't file an extension. So if you file an extension on time, at least from a filing perspective, moves. So it's no longer March 15th in the case of S Corps or partnerships, it's now September 15th. In the case of C Corps and individuals, it then moves to October 15th. So a 6 month extension extends that deadline to file, which is why you should always use one. It costs nothing and it could save you from a steep penalty. It's so silly to me how many people are anti extension. It makes no sense whatsoever. Why does it matter? Well, when taxes are due, if you've not filed on time, guess what? There's now a 5% penalty. So if you're the type of person who makes a lot of money, and let's say you owe a couple $1,000, let's say it's 3,000, well, guess what? Now you've got a $150 penalty, 5%. Well, that's a silly penalty. You could have just avoided it by filing an extension or by filing on time. And if you just wait a couple of months, well, it's going to be 5% for each month up to a maximum of 25%. So imagine you're that $10,000 person. Congratulations. You waited 6 months. You didn't file an extension. Now you owe an additional $2,500. That is money that you are literally flushing down the toilet. It makes no sense. Oh, by the way, these penalties, they also accrue interest. That's a silly way to throw away money. You can avoid it by filing an extension and making sure you file on time. So if you file the extension on time, then that gives you an extra 6 months, and then there's no reason. It's understandable sometimes you can't file on time, paperwork doesn't get to you. It's a lot to try and get things done between March and April 15th because a lot of times you're getting the paperwork at the start of March. So that's okay. Just file the extension. Now, what if you have a pass-through entity? Well, I don't know tax in a pass-through entity. I have a partnership. Well, there is still, at least for this year, a $235 penalty per month that goes up each year. And that's per partner or shareholder who does not receive their K1 for up to a maximum of 12 months. So let's do the math. Single member S Corp, 235 times 12, ballpark, you're nearly $3,000 penalty. So that's a max penalty of $3,000 per shareholder. So your partnership, you're always going to have at least two people. So that means nearly $6,000 penalty is the max for just two partners. So in other words, 3,000 per person if you wait a whole year without filing your returns on time. And it happens. There are new entities who don't file right on time because they just don't know what they're doing. It does happen. There are abatements available, but do you really want to leave things to chance, especially if you start getting a habit of this, then there are no longer abatements available. So we're talking about potentially saving thousands of dollars just by using an extension and filing on time. So easy. Do it. Proper withholding. And end of year strategy number two. It really is not an end of year strategy. This is a throughout the year strategy, but it's important to know because there may be things that you can do at the end of the year to remediate it. So the US and most states have a pay as you go tax system, meaning that tax is due when income is earned. If you don't pay throughout the year, it can lead to penalties for underpayment of estimated tax. If you owe more than $1,000, then a penalty may be assessed if you don't meet certain conditions. So, what does that mean? Well, it means if you're an employee, you have to get taxes taken out of your check. If you don't do that, if you make adjustments to your W 4 to avoid that, and you end up owing more than $1,000, you can owe a penalty because you did that. Now, here's the great thing: if you're an employee and you are having taxes withheld from your paycheck, even if you do so at the end of the year, you backload it at the end of the year, it's still considered as having been paid throughout the year if you meet the criteria of the $1,000 or any of these other tests. So, in other words, for employees, you do have the ability, if you're monitoring it and something happens kind of out of the ordinary, and you realize that you're behind, you can make up for it at the end of the year, and it's treated as if you've done it throughout the year. So, why does this all matter? Well, at the end of the day, you have to withhold at least 90% of your tax due during the tax year. So remember, we said the $1,000. So that's condition number one. Do you owe more than $1,000? For people who don't earn a lot of money, that might be an easy situation, to get it within $1,000. But if you're earning hundreds of thousands of dollars, or even $100,000, $1,000 is a small amount. So then you have to make sure you're either withholding 90% of your tax due or 100 to 110% of your prior year's tax due. So there's three situations. We talked about the $1,000, but if you're a high earner, that's pretty much always off the table. So then you get really two ways of going about it: withhold 90% of your tax due during the tax year, or 100% of your prior year's tax. What can make this tricky is if you have a large one time economic event. Let's say you sell your home and you have capital gains that are not excluded. Or let's say you sell an investment. Let's say you're a partner in a business and you guys have a buyout. Well, now you have this big taxable event. It can be hard to withhold 90% of your tax due during the tax year. And now what's going to be a lot easier is probably that 100% or 110% of your prior year's tax. Well, let's move forward a year. You're a year past that big event. It's going to be very difficult for you to withhold 110% of your prior year's tax. So you need to make sure you withhold 90% of your tax due. If you don't do that, if it's over $1,000, then you're going to pay penalties. Those penalties end up being essentially a high interest rate. And that interest rate applies each quarter, has a higher level, so it can be 12,963, for depending on it was first quarter, second quarter, third quarter, fourth quarter. That's kind of the way it works. uh, Obviously, if you're a higher net earner and you have larger tax due, this hits you more. So this makes it more worth your while to go ahead and make sure that you're getting these withholdings right year in and year out. Now, let's talk about a third end of year strategy. And this is one most people know about: retirement contributions. But we'll kind of just dig into it from a couple of different angles that maybe you haven't thought about. So, retirement contributions and health savings accounts are one of the best ways to create long term wealth. We didn't mention flexible spending accounts. Please make sure you spend your FSA money before December 31st. It is a spending account, which means you spend it or you lose it. And HSA is a savings account, which means it carries over from one year to the next. However, your HSAs and IRAs, you have until April 15th to contribute to them. So don't rush to make contributions by December 31st to those accounts. On the other hand, your 401k, you have to have those contributions made by December 31st. So make sure you prioritize those contributions instead of your HSA and IRAs. And where this especially gets important: years where you have large capital gains. Sorry for the poor grammar. A large capital gain, we'll put it like that. And the reason why is because capital gains and something called the net investment income tax, they have specific thresholds, which means that if you're above a certain threshold, you're going to pay an extra percentage of tax on all of your capital gains, all your net investment income. Well, one of the ways that you can avoid that is by staying below those thresholds. Guess what? If you utilize your retirement accounts properly, it may be possible to keep you below said thresholds and eliminate the NIIT and possibly keep you in a lower capital gains bracket, or in some cases, even exclude capital gains altogether. So, again, you have to think it through. Even if you can't exclude capital gains altogether, even if you can't avoid NIIT, is your ordinary income higher than your capital gains income? Which is the higher of the two? Can you trade one for the other? So in essence, pay the capital gains, but put money into the retirement account to lower your ordinary income tax. So these are kind of the strategies you want to think about when you have these situations. What's the best way to minimize your tax burden. So, proper contributions to retirement accounts, making sure you make those at the right time to take advantage, knowing when the deadlines are, that's a huge way you can save some money. So, in review, realistically, file on time, pay on time, contribute on time. File an extension, avoid silly penalties. Plan to pay your taxes during the year. That way, you don't have underpayment penalties on estimated taxes. This is especially important when you have large economic events. Please don't let me find out months later that you sold your house, that you sold an investment property. There's nothing that I hate more than clients telling me months after the fact. Keep me in the loop as you're going through this decision making process. That way we can plan it. Finally, contribute on time. Make the right contributions. That can lower your taxes. And especially in years where you have large capital gains, remember there's capital gains tax. There's also something called net investment income tax. We want to keep you below those thresholds and avoid those additional taxes. And we can do that sometimes just by making contributions to your retirement accounts. So thank you. If you have any questions, if you think you have a situation that applies, here's our number, 404-470-5055. My email, steve@cg-advisory.net. Visit our website, cg-advisory.net.